Hello, and thanks for joining us today. I'm super excited you could be here because today we're talking about exiting your business at the maximum value. Look, everybody messes this up. And the problem is, as an entrepreneur, you probably bank your retirement on what you're going to get out of your business when you exit. But I can tell you that of every friend I've ever had that's exited their business, all of them wish they knew what we're going to be talking about today while they were building the business for them to have got multiple maximum value. As a matter of fact, a lot of them left millions, if not tens of millions, on the table because they didn't know how to exit properly. And so what we're going to be talking about today is we're going to talk about how to prepare for a successful acquisition for your company. And there's a lot of things that I think you're going to learn about this of both acquiring another company and getting acquired yourself. So a lot of different things that we're going to be able to go over. So with us today is Andrew Gazdecki. Now, Andrew is a seasoned entrepreneur, 4 times founder, and the CEO of acquire.com, a platform transforming the startup acquisition process. Now, with a passion for building businesses, he has successfully founded and exited multiple different companies, including Bizness Apps, which he scaled to 10 million ARR before his acquisition, and altcoin.io. Through acquire.com, Andrew has helped hundreds of startups get acquired and facilitated over $500 million in closed deals. His mission is to make M&A more accessible for bootstrapped founders and small startups, giving them the tools and resources to achieve successful exits. Now, he's a recognized thought leader in entrepreneurship, in SaaS, and startup acquisitions. Andrew's insights have been featured in major publications, including the New York Times, Forbes magazine, the Wall Street Journal, TechCrunch.com, and Entrepreneur Magazine as well. With a social media reach of over 350,000 people, he actively shares expertise and lessons learned from his journey to help the next generation of founders. When he's not simplifying acquisitions, Andrew enjoys cars, skateboarding, and surfing. What's up, Andrew? Thanks for coming on the show with us today.
Yeah, thanks for having me on, Ty. Appreciate the intro. That was awesome.
Well, based on all this, you have like the coolest life ever. That's what it sounds like. I could have just summed it all up to say he has the coolest life ever and it would have worked.
Yeah, I appreciate that. Thanks.
So let me ask you, when you're talking about, getting acquired in small businesses, what do you find that some of the biggest things that founders overlook that they should be doing from the beginning to be able to exit at multiple value?
Definitely. I would say right at the top is just understanding what a sellable business looks like. So just basic things. I think a lot of entrepreneurs also overcomplicate it. So can the business run without you in the business day to day? I think that's a big, big, big one that a lot of entrepreneurs and founders just overlook. A lot of buyers aren't going to want to buy a business where, when you step away for a day or a couple hours, everything catches on fire. And then also looking at, do you have processes documented? Do you have SOPs? Do you have basic things like a training manual? One tip here could be to just go through your day to day with every department and just start documenting things. This can be used for onboarding new employees. This could be used to, strengthening your existing team and your existing processes, but just having some sort of operational manual to let others know how this business run is huge. And then when you start meeting with buyers, sharing that is going to make things a lot easier. So again, things like making sure that the business isn't heavily reliant on you, having SOPs and processes documented, having good metrics as well. So I typically work with software companies. So we look at things like how durable is the revenue? Is there really high churn or cancellations? Which essentially just means, do you have a good product or do you have a way to repeatedly attract new customers into the business? Is there some form of scale to the business, or is it kind of a just getting off the ground type business? And then just packaging all this together properly, outlining, the types of buyers that would be interested in potentially acquiring your business, being able to articulate all of this to them. Those are some things that are, top of mind. We can get more into the details, but those are usually the biggest chunks.
So I find that a lot of founders have this tendency, like when we start a business, we have no money and a lot of time. So founders basically take on every role right from the beginning, right? Then I
Yep.
find that a lot of founders are so obsessed with their ability to do those things that they have a hard time handing them over to other people. Is this something that you see is pretty common with founders? And how do they get out of that trap to start to delegate so they're not in the business, they're actually working on the business?
100%. It's one of the hardest transitions for any entrepreneur when you're building a business is you just have to let go. You have to hire people that are typically smarter than you or specialized in the roles that you're consistently doing day in, day out. And just like a piece of advice for that would be, let's say it's like a sales role, like you are the lead salesperson. At some point, you're going to need to hire a salesperson. And to do that, you're going to need to train them to make sure they understand your customer, the pitch. How do you run these sales calls? So starting right there, you can start writing down what does the script look like? What are common questions that prospects ask you on these calls? What are your common flow style for the call? And that right there is an SOP. You just documented your sales process. Now you can hire someone, train them with it. So you can do that across every department. But yeah, generally it's one of the hardest things to do for entrepreneurs. I struggle with it myself. So that right there can increase the value of your business immediately.
Is there a good way to track SOPs? Do you have technology or advice for founders? Because I think a lot of the founders don't do this. They're not tracking every position in that company and the role of what that position does. What's the best way, if they haven't done that so far, to get started doing that for them and their team?
I think step one is just open up a Google Doc. It doesn't have to be super fancy, whatever works for you. If you use Notion Doc or another type of note-taking app, just start writing down what the processes are for that department. So another example would be marketing. How do you attract customers into the business? Is it organic search? Is it paid ads? If it is paid ads, what is the week-to-week or day-to-day management for the paid ad accounts? Are you constantly looking at different types of key terms? You have to manage different budgets. If it's social media, how often do you post? How do you make the content? And then right there, you have a simple SOP for your marketing strategy and how you're attracting new leads or new customers into the business. And then you can hire someone, train them with that document. And it can get obviously way more detailed than that, but just that basic sort of how does sales run? How does marketing run? Is huge. And all you really need to do to get started is just think about what does that look like on a week to week basis and just write it down in Google Drive and just keep it there.
So I think valuation is something that a lot of us are just confused about. Maybe because there's so many different ways to value a business. But what should we be thinking? What do you teach your founders that we should be thinking about as we're building the business of things that are very important that will have to do a lot with the exit value? We talked about SOPs, obviously, right? And we talked about not working in the business, but what are some things we should be paying attention to? Like, are we paying attention to, like you said, like a cohort analysis? Are we looking at how long we're retaining that customer? Or what are some of the main things that founders just overlook oftentimes that are really important for them getting maximum value in the exit?
Definitely. I think having bad business models can really destroy a valuation. Like if it has a business model where it's just all one-time fees or something like that, and it's a SaaS product. And the reason for that is the new buyer is going to have to manage all of these customer relationships, and they're not generating any additional revenue from doing so. So you're going to get a heavy discount from all these one-time fees that you may have incurred during the life of the business. So that's a big one. Another one would be having too much customer concentration. So what that can mean is you have one really large customer that takes up 20 to 30 or even more than that, 50% of your revenue. And what that tells a buyer is that the revenue is just, it's risky, where if they buy the business, that customer leaves, the valuation can drop by up to 50% or more. So those are two ones, just thinking about building the business in a way where you're generating revenue every single month from your customers and then not being so reliant on one really, really large customers. Those can be deal killers in my experience.
What about financing? What do you talk to founders about along the way of building a business? And I think about this because, when I look at Harvard graduates, like one of the benefits they have is the people they meet while they're in school. And then a lot of them are launching endeavors and right out the gate, they're going out to raise capital, right? Somebody
Yeah,
like me, like I never learned any of that. I mean, I bootstrapped it from the ground up. And I have a large part of our audience is that same way, where I think they're used to bootstrapping, not used to VC or angel. So, what do you say about that? When you're helping founders kind of build up, do you advise them that they borrow money or access capital to do it? Do you advise that they access debt? Do you advise that they access equity financing? Like, what are those conversations like? What helps a startup get the money they need to actually get to a point where they can be acquired?
definitely. I think the first thing to do there is to understand what you're trying to build. I think a lot of entrepreneurs go out to raise capital and they're not essentially trying to build a multi-billion dollar business. It's, a business that could be worth 10 or 20 or 30 or 40 or $50 million. which is a huge business. That is a massive windfall for an entrepreneur. But once you take on venture capital for a business like that, it kind of breaks all of that down because you're going to have to be pushing the business in ways that may not be a smart thing to do to get to the larger outcomes. Think of it as like boom or bust. So that's the first thing. What kind of business are you building? Is this a true multi-billion dollar opportunity? Do you really want to build a business like that? And then if so, why is a good question as well. Because when you go to sell your business as well, if you've raised a lot of venture capital, you're going to have to typically pay back your investors at a one-time liquidation preference, which essentially means if you raise, $5 million, then when you go to sell the business, investors are paid back first, which is going to take from your final exit amount. Um, but again, it just depends on the entrepreneur. I would recommend bootstrapping. I think you generally will build better businesses. That way, you really are forced to speak with customers, get really close to them because they're the ones paying the bills. But again, I think it's a very personal question, and it is really going to be based on personal ambition and market opportunity, in my opinion.
I appreciate that. Andrew, another thing I see a lot of our tribe struggles with is that, they're so fixed on top end revenue, what they're selling, not what they're collecting or margin, right? And I see a lot
Yeah.
of entrepreneurs make this mistake. They even boast, they brag about it, right? So, like, what's your advice about cash flow management or really focusing on a margin? And how important truly is it? Because I think we hear that EBIT is so important and profit margin is so important, but like, give me a rundown of that, of the looking at the profit margins and the net versus necessarily the gross.
Totally. I think it depends on how fast your business is growing. So, what I typically see is related to valuation specifically, we see two types of multiples. We see revenue multiples and we see EBITDA multiples or net profit multiples. We'll see revenue multiples if the business is growing really fast, so 100% year over year. There isn't a lot of profits in the business because they're investing everything to grow faster. Those are rare outcomes. That's where, again, the business is expanding very quickly. And the most logical multiple to give the business is a revenue multiple. Um, More commonly would be a profit multiple where the business has slower growth, sometimes stagnant or declining. And those businesses, it's really important. If it's slow growth and there's not a lot of profit, then that business essentially isn't sellable. So if you're not focused on building a profitable business and it's not necessarily growing very fast, it may not be worth anything to buyers. So if you're in a situation like that where it's not growing and it's not profitable, you need to make the business profitable if you want to exit it, in my experience.
And how do we figure out what multiple we may have? Because I think a lot of our tribe too struggles to know what industry they're actually in. And I mean, it sounds crazy. Like they might say I'm in real estate, but if you're really looking at NIAX, there's like 30 subcategories of real estate you could be in, for
Yeah.
example. So like, how do they figure out what can they even make the determination? Like if you look at Credit Suite, like we're a software company on paper, but we also are an education company because we do education, we do business credit financing. So how do we figure out what multiple we may have of the industry that gives us the highest multiple?
Yeah. You can look at comparables. So like similar businesses that have sold that could be competitors or in a simple market segment that you're in. But generally there are rules of thumb. Like SaaS businesses will sell for anywhere from 3 to 10 times net profit. So you typically will have some sort of range. This is also oversimplification, but if you go on like ChatGPT and just ask like, hey, what are the multiples for my business? Can you find 5 examples of similar businesses that have sold with multiples? That'll give you a range as well. Because valuation is also, part art, part science. So you don't want to just say this is exactly what the business is worth. You just want to have kind of a ballpark figure.
What do you see happens when somebody exits in due diligence? Like, what kind of due diligence thing come up where somebody's trying to exit and they're like, oh man, and they get caught in something to do with due diligence that's common that they didn't think about that lowers the value? Because I hear this all the time, right? Somebody comes in and says, your business is worth $10 million. But then when they get in and start doing the due diligence, then all of a sudden they find this, don't like this, and it reduces that. So, like, what can we be focusing on that we don't get to that final stage of selling our business and go, oh man, I didn't know that stuff would really hurt me as much as it did during that due diligence period.
Yeah, definitely. I think the big one there, which is also kind of an obvious thing, is just surprises. If you're going into due diligence with a buyer, just assume they're going to find out everything, both good and bad. And so you want to get in front of any bruises or bad parts of your business or things that may just appear not good. That could be a customer's canceling. It could be bugs in your product. It could be an issue with a former teammate. Like whatever it may be, just be upfront about that with the buyer rather than the buyer finding it on their own. It's a big surprise. And now the buyer's thinking, what else could be wrong with, this business? What else am I going to find out? And that can completely derail an acquisition. So just any sort of surprises or anything that, maybe could be improved on the business, just be upfront about it.
Acquire.com. First of all, what the heck? How'd you get the name? How'd you get the domain acquire.com? I just out of curiosity, I got to know that.
Yeah. Yeah. The short story there is I actually reached out to the owner like 4 years ago. I got the domain about a year and a half, 2 years ago. He wanted 900,000 for the domain. I obviously said that was too high. Then ended up buying it for 200,000.
Wow, that's
About a
pretty
year and
cool.
a
So
half.
just diligence.
Yeah, he just reached out and said he's looking to sell it. And I said, this is the most I could possibly pay, and transacted actually when I was on vacation with my family.
So were you already Acquire before then? You just didn't own acquire.com?
No, we were called Micro Acquire. And so we dropped the micro and now we're just acquire.com.
That's pretty cool. So how can and how does Acquire help a small business owner better position themselves for to be acquired?
Definitely. We've created a platform where we give you access to essentially more buyers than you could possibly ever reach on your own or with another M&A advisory firm. We also walk you through the acquisition process step by step with hands-on support. So from valuation to preparation to buyer outreach to creating the initial listing or sim creation or financial recasting, we're with you every single step of the way to make sure that you truly maximize your acquisition.
So is this, how do you compare this to an investment banker going through a firm that helps me actually potentially sell my business?
We like to think of ourselves as a tech-enabled investment bank where we leverage data to access the most specific buyers that are interested in acquiring a business like yours. For example, we have over 500,000 buyers registered on our platform, and we collect information on everything that they're looking to acquire. So if you are a SaaS business with more than 1 million in revenue in the MarTech space, we can specifically outline buyers that are actively looking for acquisition targets like yours. So we essentially are more efficient at selling businesses than other options.
So if we flip it a little and let's say that a lot of insight about selling our business, what if I want to acquire? Like what's some of your best advice if I'm a business owner, I own a business here, I own Credit Suite, and I see another business I want to acquire. So in that case, like what's some of your best advice for me to be able to acquire another business?
Definitely. I think due diligence is going to be huge. Definitely, if you haven't gone through a process like this, you can hire a third-party firm. We have referrals for this where you can do something called a quality of earnings check, where you can review all the financial information to essentially verify that it is accurate and isn't less or more than maybe what the seller is representing. But also getting an understanding of what are you truly looking to acquire and why. We have hundreds of businesses listed on the Acquire platform that range from, $50,000 all the way up to, tens of millions of dollars. So are you looking to expand into a new market? Are you looking to, expand your products or services? Are you looking to potentially acquire a business rather than starting a business? Outlining that to narrow down your search, I think is key.
So how do I get financing for this? And I think that's one of the biggest questions. Maybe you get. I definitely hear it too on the acquisition side. What are some of the best options you found for a small business or for somebody that's looking to acquire a business to get the financing they need to do so?
Definitely. From my experience, there's really two routes. There's typical SBA bank financing. That's for acquisitions up to $5 million. You can go larger than that, but the loan size is up to 5 million. Those are going to be typically harder to get, and you're going to need to give a personal guarantee with your bank. So if you're interested in that, you can go to your local bank or whoever your business bank's with, and you can ask about their SBA loan process. We also have referrals for that as well. There's some strict requirements to get those types of loans. Specific types of businesses, they need to meet a certain level of profitability. They aren't for unprofitable businesses. So that's the main use case for SBA loans. And then the second option is going to be to get financing from investors. So that would be where you locate a type of acquisition that you want to close and you leverage either investors that you know or the existing investors in your business.
What are the biggest rewards of doing this versus building? And I read a great book. I don't know if you ever read it called Buy, I think Buy versus Build. And so, but from your perspective, like, what are some of the best benefits of and drawbacks, the pluses and minuses of acquiring a business versus building it from scratch?
Definitely. I think for the software industry or the startup industry specifically, you're able to essentially skip over the hardest part of building a startup, which is where you're finding product market fit. You're scraping and clawing to get a handful of customers, figure out the pricing model, what features are actually important. We work with a lot of entrepreneurs that are they're selling these businesses because they want to swing at something bigger. They want to go after, the 50 or $100 million exit. Business generating a couple 100,000 or $1 million just isn't exciting for them. But they're being acquired by buyers where that is exciting, where they're looking to have a really nice, profitable lifestyle business and expand the business to a couple million or something like that. And your probability of succeeding there are going to be a lot higher than if you're trying to swing at $100 million, potentially $1 billion opportunity. So that's the smartest reason to acquire a business is you aren't going to have a 90% chance of failure. You're going to have probably a higher probability of 90% of success.
So if you acquire, we've talked about what you do to help us as small business owners position ourselves to be able to exit at maximum value. What does Acquire do to help on the buying side? Like, are there services and there's support that you do to provide help to somebody that might be a first-time buyer out there, first-time acquiring a company to help them overcome those potential pitfalls to be able to have a successful acquisition and to be able to buy a company?
Yeah, we built tools to essentially streamline and automate the acquisition process for buyers. So we'll generate an entire due diligence checklist for recommendations on going through financials or customer interviews or the product to just online research of the business to make sure that, you check the boxes of things that you really should look for before you acquire business. We also help generate a letter of intent, asset purchase agreement, or flowing the transaction into an escrow service so you can close safely and securely. We also just have a team available to help along the way for buyers too. But the big thing we help with both sides, where sellers are looking to find buyers and buyers are looking to find sellers, is with when you're a buyer on the platform, you can set your preferences of what you're looking to acquire. Whenever a deal goes live that meets those preferences, you'll instantly be notified. So you aren't scouring the web or reaching out to people on social media asking if they're trying to sell their business. You get notifications consistently for relevant opportunities to you.
You've mentioned a couple times throughout this, even including, ChatGPT and technology's part in this. What do you see? Like technology, AI trends, like what are you seeing trending and changing in the M&A world that we should really know about?
Definitely. From my vantage point, we see tons of AI companies. Almost every software company we sell now has an AI angle, whether it's AI first or they have an AI component. AI is absolutely here to stay. And we're seeing a lot of that, which is exciting. We're seeing a lot of buyers really lean into that as well. And they're initially when we saw these, quote unquote, chat GPT wrappers coming out onto the market, no one wanted to buy them. Everyone thought they were a phase, it was a fad. And now we're seeing the exact opposite, where buyers are really understanding this is here to stay. And we're seeing entrepreneurs build really interesting businesses in the category. And we're excited to see it keep going.
Yeah, and I'm interested in that. Like, from your perspective, what are people buying right now? Like, what are some of the hottest trends of business types? And you mentioned AI. Like, what are the best type of businesses right now that are selling? Are they SaaS companies or something else?
Yeah, SaaS and AI and just general software. But the one thing they mainly have in common is they're all profitable. In 2021, we saw a lot of businesses that were unprofitable being acquired. But since then, we've seen profitability almost being king in acquisition. So it's the main driver for valuations, for buyer interest. We see that if businesses have an 80% margin or above, um, pretty much all of them will get some form of offer from our buyer pool on Acquire. So if the business it has some form of longevity, meaning it's been around for ideally more than 24 months and it's profitable, it's going to get a lot of interest from buyers.
Profitability just seems to be super important here.
Yeah. Especially with the buyers that we work with. 100%.
So acquire gets acquired. You're starting over. You want to build a highly profitable business. Years down the road, you can exit. How would you do it? What are you going to do? Like, what are the things in the front of your mind that pop into your head to say, okay, here's probably the industry I would start in. Like, here's some things I would be doing right from the beginning to as quickly as possible get this thing to where I could exit for maximum value.
Definitely. Honestly, I always joke and say if it wasn't for Acquire, I'd be acquiring businesses on Acquire. And I really mean that. I think there's some great acquisition opportunities where it's a SaaS company, the founder has some form of product market fit. There's a few marketing channels they haven't really explored. I think those are great acquisition opportunities. Again, the goal here wouldn't be to build a really large $100 million empire, but I think there's a lot of opportunities like that that can lead to some really nice seven-figure outcomes.
And what do you think mistakes, just some of the most common mistakes that you see that really aren't that hard to avoid if you just would have thought about them and known about them beforehand?
In the acquisition process or
I
when you're
think with
growing the
both. I
business?
think let's look at it from if I'm trying to get acquired, what are the mistakes I make where I just leave millions on the table? And then if I'm trying to acquire a business, what are the no you know the dumb mistakes that people make that mean where they're buying a bad asset or paying too much?
Definitely. I would say on the sell side, it's overpricing. If your asking price or your valuation is too high, what you do is you scare away all the buyers. And when you scare away all the buyers, you have no leverage. Typically, in those situations, I see two things where the business doesn't sell or they get one offer and it's usually an offer lower than their initial asking price or something like that. What you want to do is the flip side. You want to price with a realistic asking price or realistic valuation, because what that does is that creates a lot of interest from a lot of different buyers. A lot of different buyers leads to multiple offers. Multiple offers leads to a lot of leverage, which allows you to negotiate better terms or a higher valuation. And then on the buy side, I would say just sloppy due diligence or not, uh, just wasting time is another big one, or just not knowing what they're doing in due diligence. So on sloppy due diligence would be just missing key things, just understanding if this is hundreds of thousands or millions of dollars, definitely invest in a third party review of the business if you can afford it. It's a good way to essentially protect any downside risk. And then just wasting time, meaning you submit an LOI and you're not really serious about acquiring the business, or you're just not sure. That can hurt reputation, and it's a fairly well-known market. So if you become known as a buyer for wasting sellers' time, it's going to make it even harder to acquire a business down the road.
Andrew, great stuff today. If anybody is on here watching and saying, "Okay, I want to learn more. I want to learn more about acquiring a company or selling my own," what steps should they take?
Yeah, go to acquire.com. You can create an account immediately and reach out to us as a team, and we'd be happy to help.
Andrew, thanks for coming on with us today.
Yeah, thanks for having me.
So look, if you're watching this, as I said in the beginning, selling your business for maximum value is really important because more than likely your retirement, how you live the rest of your life is based on this. It's not something you want to screw up. As a matter of fact, it's probably the most important thing you could get right in your business, and we all get it wrong. So make sure that you go to acquire.com because when you go to acquire.com, one of the first options you have is, are you a buyer or are you a seller? And so there's benefits both ways. You can actually look, and there's a lot of really cool listings here for businesses you may acquire. You may all of a sudden realize you can exponentially increase your revenues and profits by acquiring another business. Maybe it's a competitor. Maybe it's another thing that you're doing that you're outsourcing internal that you can bring internal. A lot of different options, but you want to check out acquire.com because there's a lot of opportunities for you to buy businesses that could exponentially increase your revenues and profits. And then on the other side, it's phenomenal for sellers because there's all kinds of information that you're able to get at acquire.com and with the team to be able to learn more about selling your business at maximum value, to not leave 7 and 8 figures on the table like so many people do. So make sure you go to acquire.com. Everything you need is there to either sell your business and be able to get it acquired or to be able to buy another business. Either way, it's going to potentially put millions of dollars in your pocket, whether it be increasing profits by acquiring or getting acquired down the road and doing it the right way. So make sure you check it out at acquire.com. Thanks for tuning in. Take care. Have a great day.